The human behavior in relation to money is always dominated by fear, greed, and hope. Well, candlestick analysis will help you to understand these changing psychological factors by showing you how buyers and sellers interact with each other. Candlesticks are basically a visual representation of what is going on in the market. By looking at a candlestick, you can get a valuable information about the open, high, low, and close of the price, which will give you an idea about the price movement. In today's video, you'll discover how to recognize the most important candlestick patterns, the psychology behind their formation, and what do they indicate when they form in the market. First pattern is the engulfing candlestick. This candlestick formation consists of two bodies, the first body being smaller than the second one. In other words, the second body engulfs the previous one. Here we can have a bearish engulfing bar and a bullish engulfing bar. In case of a bearish engulfing bar, this pattern tells us that the sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a potential trend reversal. Why is that? Because buyers are losing control of the market, and sellers are trying to push the market to go down. The bullish engulfing pattern tells us that the market is no longer under the control of sellers, and buyers are gaining strength. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. When a bullish engulfing candle forms at the end of a downtrend, it signals a potential reversal. This example shows clearly how the market changes direction after the formation of a bullish engulfing pattern. The smaller body, that represents the selling power, was covered by the second body, that represents the buying power. Very important. Don't try to trade the market using this price action alone, because you will need other factors of confluence to decide whether the pattern is worth trading or not. What I want you to do for now is to get the skill of identifying bearish and bullish engulfing bars on your charts. This is the most important step for the moment. Second pattern is the doji candlestick pattern. Doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is indecision between buyers and sellers. There is no one in control of the market. The opening price is the same as the closing price, and this signal means that the market didn't decide which direction it will take. A doji could anticipate a reversal, or it can be a sign of consolidation. This example shows how the market changed direction after the formation of the doji candlestick. The market was trending up, meaning that buyers had more strength. The formation of the doji candlestick indicates that buyers are unable to keep price higher, and sellers push prices back to the opening price. This is an indication that a trend reversal might be on the cards. However, always remember that a doji indicates indecision in the market, and you will often find it during periods of resting after big moves higher or lower. Third pattern is the morning star. The morning star pattern is considered a bullish reversal pattern. It often occurs at the bottom of a downtrend, and it consists of three candlesticks. The first candlestick is bearish, which indicates that sellers are still in charge. The second candle is a small one, which represents that sellers are in control, but they don't push the market much lower, and this candle can be bullish or bearish. The third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the first candle, and this candlestick holds a significant trend reversal signal. The morning star pattern shows us how buyers took control of the market from sellers. When this pattern occurs at the bottom of a downtrend near a support level, it signals a potential trend reversal. Here the pattern occurred during an obvious bearish trend. The first candle confirmed the seller's domination, and the second one produces indecision in the market. Basically, the second candle indicates that sellers were struggling to push the market lower. The third bullish candle indicates that buyers took control from sellers, and the market is likely to move upward. Next is the evening star pattern. The evening star pattern is considered a bearish reversal pattern that usually occurs at the top of an uptrend. The pattern also consists of three candlesticks. The first candle is a bullish candle, the second candle is a small candlestick, and it can be bullish or bearish, and the third candle is a large bearish candle. In general, the evening star pattern is the bearish version of the morning star pattern. Here the market was trending up. the first candle in the pattern indicating a trend continuation. The second one is a short candle indicating a price consolidation and indecision. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick moving lower than the previous candlestick indicates a potential beginning of a new down move. Another important candlestick formation is the hammer. The hammer candlestick is created when the open, the high and the close are roughly the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. The hammer is a reversal candlestick pattern when it occurs at the bottom of a downtrend. This candle forms when sellers push the market lower after the open, but they got rejected by buyers, so the market closes higher than the lowest price. Here the market was trending down, and the formation of the hammer represented a significant reversal pattern. The long shadow represents the high buying pressure from this point. Sellers were trying to push the market lower, but at that level, the buying pressure was more powerful than the selling pressure, which resulted in a price reversal. The most important aspect to understand is the psychology behind the formation of this pattern. If you can understand how and why it was created, you will be able to anticipate the market direction with a higher accuracy. The shooting star is another important reversal candlestick pattern. The shooting star formation is formed when the open, low and close are roughly the same price. This candle is characterized by a small body and a long upper shadow. It's basically the bearish version of the hammer. Very important, the shadow of the shooting star should be twice the length of the real body. This example shows a perfect shooting star with a real small body and an upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal signal. The psychology behind the formation of this pattern is that buyers tried to push the market higher, but they got rejected by the selling pressure. When this candlestick forms near a key resistance level, it should be taken as a high probability setup. Another important formation is the inside bar. The inside bar is a 2-bar candlestick pattern, which indicates price consolidation. In order to confirm this pattern, you need to see a candle on the chart, which is fully contained within the previous bar. In this manner, the inside bar candle should have a higher low and a lower high than the previous candle. This candlestick is considered a bearish reversal signal when it occurs at the top of an uptrend, and it's a bullish signal when it occurs at the bottom of a downtrend. In this example, you can see how the trend direction changes after the inside bar formation. The bullish inside bar pattern occurred at the bottom of a downtrend. Here, sellers were pushing the market lower. Price starts consolidating, and this indicates that the selling power is no longer in control of the market. The bearish inside bar is the opposite of the bullish one, this one occurring at the top of an uptrend, indicating that buyers' domination is losing strength and the beginning of a new downtrend is possible. For me, since the inside candle has a lower high and a higher low than the previous candlestick, this indicates consolidation. Bulls cannot manage to create a higher high, and at the same time, the bears fail to create a lower high. As such, there is not sufficient buying or selling pressure to break the previous bar high or low. When this candlestick pattern happens during an uptrend or a downtrend, it's probably better to see it as a continuation pattern, which offers a good opportunity to join the trend. Tweezer top and bottom is another useful pattern. Tweezers are reversal candlestick patterns that signal a potential change in the price direction. The tweezer bottom candlestick pattern is a bullish reversal pattern that can be spotted at the bottom of a downtrend. It consists of 2 candles, where the first candle is in line with the bearish trend, while the second one reflects more bullish market sentiment as the price moves higher in the opposite direction. If this price action happens near a key support level, it indicates that a bullish reversal is likely to happen. The tweezer top candlestick pattern is of the same structure as the tweezer bottom, except for the fact that it happens at the end of an uptrend, and therefore it's a bearish reversal pattern. The first candle is bullish, and it continues in the same direction, while the second bearish candle indicates that the trend may be changing soon. The tweezer top occurs when the buyers push the price higher. This gives us the impression that the market is going up, but the sellers surprised buyers by pushing the market lower and closed down the open of the bullish candle. These two patterns signal price reversals, and we can trade them more efficient if we can combine them with other technical tools. Both the bottom and the top tweezers are only valid when they occur during uptrends and downtrends. Their appearance during choppy trading conditions is practically meaningless, and it signals the market's indecision to move in either direction. Candlesticks are flexible, but they shouldn't be used alone in your analysis. You don't open a buy position every time you spot a bullish engulfing candle, and you don't short the market every time you see a shooting star. Candlestick patterns are best used in combination with support and resistance, with trend lines, and other technical tools such as moving averages or pivot points. Also, the time frame is very important, but we'll discuss about these concepts in future videos. If you found value and learned something new, give us a like to show support. Subscribe to our channel and click the bell icon to stay in touch when we upload new videos. Until next time.